Smart Owl FXEA looks very impressive at first glance. The forward results are strong, the win rate is high, and the growth looks excellent. But that does not automatically mean the EA is robust. In this review, we will look at the forward test, the long-term backtest, the trading logic, and the hidden risks. This review is based on the information available as of May 6, 2026. Let's start with the positive points. This EA is not just a short-term flash. It has a public forward test running since 2023. There are also multiple public signals, and it has been tested on more than one broker. Those are real strengths. That is why this EA is worth a closer look. Now let's check the public forward results. The headline numbers look very strong. Growth is 344%. The win rate is about 89%. And the profit factor is around 3.98. On the surface, that looks excellent. Another positive point is that this is not just one isolated signal. There are multiple public signals related to Smart Owl FXEA. That improves confidence a little. It suggests the result is not based on a single lucky account, but we still need to be careful. Why? Because big percentage growth can look more impressive on a small account. So when you see a high growth rate, do not stop at the percentage. Always check the actual money involved. In this case, the account size is small, so the percentage looks huge, but the actual scale is still limited. That does not make the result fake. It simply means the growth number alone can be misleading. Next, let's move to the backtest. I ran my own long-term backtest from 2005 to April 25, 2026. The test covered the target currency pairs with a fixed 0.01 lot size and variable spread. The overall result was profitable, but the pattern is important. The net profit was about $924. The profit factor was 1.69, and the maximum equity drawdown was about $353, with the lot size fixed at 0.01. So this is not an extreme Brid or martingale disaster type of EA, but it is also not a perfect all-weather system. The key point is this. The early years were weak. From 2005 to around 2012, the performance was weak or flat. Then the picture changed. From around 2013 onward, the result became much stronger. That suggests the logic fits newer market conditions better than older ones. This is important. It means the EA may be adapted to a specific type of environment, rather than being universally robust. Now, let's talk about the trading logic. This EA appears to target the late-night rollover period. The basic idea is simple. Around 2350 server time, it places a limit order. If price reaches that level, the EA enters the trade. If the order is not filled by around 0025, the pending order is cancelled. So this is a short holding time strategy built around a very specific market window. When we look at the trade history chart, we can see that the entries often happen around that late night period. The trades are short-term. They are in and out quickly. That is one reason the equity curve can look clean when conditions are favorable. The M30 chart shows the same general idea. White marks the buy trades. Red marks the sell trades. The overall behavior is not random. It is clearly built around a repeatable late-night setup. That is interesting, but it also creates another problem. Broker conditions matter a lot here. At rollover, spreads can widen, slippage can increase, and execution quality can change. That means the exact same EA can produce different outcomes on different brokers. This is especially important for a strategy like this, because it is trading in a sensitive time window. And that leads to a bigger point. Scalping style systems often have reproducibility risk. Small differences in spread, speed, or slippage can completely change the result. One broker may show a good curve. Another broker may show a much worse curve. So even if the forward result looks strong, you should never assume you can copy the same result everywhere. Now, let's look at the parameter settings. This is where the risk structure becomes clearer. Each currency pair has its own settings, and in some pairs, the stop loss is much larger than the take profit. For example, some pairs use a relatively small target, but a very wide stop loss. This means one losing trade can erase many winning trades. That kind of structure naturally creates a high win rate. You collect many small wins. Then, from time to time, you take one much larger loss. So, the high win rate is real, but it does not automatically mean the risk is low. This is one of the biggest lessons in EA reviewing. A clean curve can still hide danger. Many small wins can look safe for a long time, but if the loss structure is unfavorable, one bad trade can hit much harder than expected. So never evaluate an EA by win rate alone. Always check how it loses, not only how it wins. So, what is the final view on Smart Owl FX EA? The positive side is clear. The forward test is strong. There are multiple public signals, and the rollover-based idea is interesting. But the risks are also clear. The system is broker dependent. The stop loss can be much larger than the take profit, and the long-term robustness is still uncertain. So my conclusion is simple. Smart Owl FX EA is impressive at the moment, but structurally, it still looks fragile. It is an EA to watch closely, not an EA to trust blindly. If the forward performance remains strong over a much longer period, that will improve the case. But for now, caution is still necessary. If you found this review helpful, please like the video and subscribe. And if you want more EA reviews based on real forward tests and independent backtests, check the links below. Thanks for watching.